Hello everyone, it is Tabitha again, and today we are going to be looking at notes and understanding from IB chapter 4.4 of globalization, in this case, exchange rates. And like always, we'll be starting off with standard level content at the beginning of the video, and then by the end of the video, there will be higher level content too. Alright, but to start with the basics. So continuing on the knowledge and understanding that we gained from the previous chapter, which is about economic integration, let's move on to one of the main benefits yet limitations of complete economic integration, which is where we talk about the literal value of money. So to begin with, we need to mention a new term called an exchange rate. I'm sure you've heard of it before. And an exchange rate, just by using a casual definition, is how much one currency costs when transferred to another currency. But by the formal IB definition, it is the value of one currency expressed in terms of another currency. For example, €1 equals, at the time that this textbook was written, $1 in the US and 12 cents. Okay, this means that €1 may be exchanged for $1 and 12 cents. Currencies are exchanged and traded on the foreign exchange market, the largest market in the world in terms of cash movements. So although up to this point before, we've talked mostly about product markets or maybe labor markets, if you guys remember from Unit 1.1 at the very beginning of the syllabus, I quickly mentioned the different types of markets that we would be looking at, which include product markets, labor markets, stock markets, and something called a Forex market, which when you take the words foreign exchange, when you take the FO and the FOR and we take the EX, we create the Forex, the word Forex. So this is the Forex market, where you quite literally exchange currencies all around the world. And obviously, because you exchange the literal currencies, it is the largest market in the world in terms of cash movements. The market here includes the trading of foreign currencies between some essential stakeholders, including governments, central banks, private commercial banks, MNCs, I'm drawing right through some of these words, and other financial institutions. And when we talk about exchange rates, we also have to talk about putting them into a system. So what is an exchange rate system? Well, there are a number of different exchange rate systems operating in the world. The way that a country manages its exchange rate is known as the exchange rate regime. And we're going to be looking at three different forms of exchange rate systems, okay? We're going to be looking at fixed, floating, and managed systems. So we're going to start with fixed. So like I said before, all countries throughout the world use either a fixed, a floating, or a managed exchange rate system. And for countries using fixed exchange rates, it is an exchange rate regime or system where the value of a currency is fixed. Okay, no duh, or pegged to the value of another currency, to the average value of a selection of currencies, or to the value of some other commodity such as gold or specific good. As the value of the variable that the currency is pegged to changes, then so does the value of that currency. Okay, so let's say, for example, I am in a super small country where I say one value of currency. I'll put V for value of my currency in this made up country. And let's say I want to follow a fixed exchange rate regime. Well, to do this, I would have to fix or peg my currency to one of these three options. For example, if I was wanting to equate $1 to my value, then as the US dollar goes up in value, then so does mine. As the US dollar goes down in value, so does mine, because we have to remain equal. The same thing can be said if I want to be equal to an average value of currencies such as $1 and to €1. In this case, I would take the average value of a selection of currencies, because there's more than one here, and then equate it to my value. So as the average between these two goes up, so does my value. As it goes down, so does my value. And lastly, I could equate it or peg my value to a specific good or commodity, such as something really valuable like gold. So let's say I want to equate it to, a diamond. What does a diamond look like? Okay, let's say that's a diamond. If I want to equate one value of my thing to a whole diamond, then as the value of a diamond goes up, then my value goes up. As the value of a diamond goes down, then so does the value of my currency, okay? And hence, that's what it means for an exchange rate to be fixed, because it's dependent on either another exchange rate, an average of different exchange rates, or on a specific commodity. So just to simplify what I said, as the value of the variable that the currency is pegged to changes, then so does the value of the currency, okay? So deciding upon and then maintaining the fixed value of the currency is usually carried out by a specific stakeholder, in this case, the government or the central bank of a given country. If the value of the currency in a fixed exchange rate regime is raised, then we say that this is a revaluation of the currency. If the value is lowered, then we say that this is a devaluation of the currency. These are two new terms you definitely need to know. So knowing that my currency is in a fixed exchange rate regime with the value of a single diamond, if the value of the diamond goes up and so does the value of my currency, then this is called a revaluation of my currency. If the opposite happens and the value of a diamond goes down, and so therefore does the value of my currency, then this is considered a devaluation of my given currency. But now let's talk about how it is maintained. As you mentioned before, it is usually controlled by the government or the central bank of a given country. So a fixed exchange rate is maintained by government intervention in the foreign exchange market, the Forex market here. It is most easily explained using an example though. So we're going to take an example and look at a graph with this example on the next slide. We're going to be looking at how in the real world, the Barbadian dollar has been fixed against the US dollar at a rate of 2 Barbadians to 1 US dollar since 1975. So this is actually really easy ratio. So it's just 2 Barbadian is equal to 1 US, okay? So that should be really easy to keep in mind. And then if we wanted to find the value of 1 Barbadian dollar, that'd be equal to 50 cents US. And we're going to be looking at calculations for these type of things in a minute. So don't worry about that right now. But now we're going to be investigating how the government uses government intervention in the Forex market to control how a fixed exchange rate either devalues or revalues. All right, so considering we are in the Forex market, which if you don't have a grasp on the idea of it so far, essentially consider how a market of goods and services is tangible. You can literally buy a good and you can literally buy a service. However, the labor markets and the Forex market are intangible markets. You can't see them, but they exist, okay? They exist somewhere in the scope of the world. So now we're going to be looking at how in the intangible Forex market, how fixed exchange rates are affected when the supply of said currency increases, using the same example from before. So really quickly looking at this graph, we can see that because the supply curves are labeled just S and the demand curves are labeled just D, this is a micro market diagram with quantity on the x-axis and price on the y-axis. And because we're considering this from the perspective of Barbadian dollars, we're going to be looking at the quantity of Barbadians on the x-axis, and on the y-axis, we're going to look at the price of Barbadians in the other currency we're looking at, which is US. So that's how you're supposed to write it. Make sure it's the price of the focus currency in the second currency. And as you guys can see, we're going to be shifting both the supply and the demand curve in this case. So let's go ahead and read the analysis for it. As shown in this graph here, it shows a situation where the supply of Barbadian dollars is increasing on the Forex market. And this may be cause for a multitude of examples. But for example, by Barbadians purchasing greater amounts of imports, they increase the supply of the currency on the market. So like I said before, the Forex market is an intangible market, but it does exist even though you can't physically see it all the time. But essentially consider that let's say that this is the Forex market, this corner right here. And let's say we have X value of dollars floating here. We have Y value of euros floating up here. We have Z values of, I don't know, the Barbadian dollar floating up here, okay? As Barbadians buy more imports from other countries in their currency, therefore their currency is shipped to other countries and taken out of their own country, the money that they use to buy imports appears in this little Forex market area here, meaning that as you buy more imports from other countries and your currency that you buy the imports with is being sent out, it's being sent out to the Forex market. Hence, when you buy more imports, it increases the supply of your currency in this Forex market. So thus, continuing the graph, we can say that the supply curve for Barbadian of dollars, since it's increased in the Forex market, it increases. And remember, we should remember this obviously from microeconomics, but when we increase supply, it moves to the right, okay? So that's what it shows right here, from S1 to S2, okay? And just for the sake of organization, the textbook labeled each of the shifts in order. So we're going to start with the supply. So when supply increases with Barbadian dollars, we're going to label that number 1. However, considering again what we know about surpluses and shortages from microeconomics, we know that if we shift the supply and we increase it, but the demand remains the same, and there's an excess supply in this area here, which is also known as a surplus, so just abbreviate that. But there is a surplus or an excess supply of Barbadian dollars in the Forex market now, specifically between the two given quantities drawn here of Q1 to Q2. And as we know, if there is no government intervention from the Barbadian government after flooding the Forex market with the surplus of their currency, then the value of the currency is going to drop from the original equilibrium here to the new equilibrium here, which means that overall, the value of the Barbadian dollar decreases, which also can be said as the exchange rate of the dollar will fall. And this can be proven because if we look at the graph and we take this new equilibrium, draw it across here, and say it's perhaps 40 cents, then we can see how the price of Barbadians in US dollars decreases from being worth 50 cents to being worth 40 cents. Overall, it's decreasing and the exchange rate is falling. And if we were to draw that out, that would mean that before, whereas one Barbadian dollar equaled 50 cents US, it would then change to one Barbadian dollar equals 40 cents US, meaning that to buy the same good, you'd have to spend more money in Barbadian dollars. So clearly that's why governments and countries and economies do not want a low exchange rate in the context just like this, because that basically means they need more money to buy the same amount of goods. Therefore, the government of the Barbadian currency wants to intervene to make sure it does not fall because of the surplus of new Barbadian dollars. Therefore, in order to maintain its fixed exchange rate, to be fixed at this specific exchange rate according to US dollars, the Barbadian government needs to somehow get rid of the surplus to get rid of the increase of Barbadian dollars in the Forex market. And one way they can do this is by buying up the excess supply of its own currency on the foreign exchange market, thus shifting the demand curve from D1 to D2, from right here to here. So shifting the demand curve outwards. Remember, same with the demand curve, if you remember from microeconomics, if I get rid of these two, shifting the demand curve also increases it from the left to the right. So as you guys can see here, it's also labeled number 2 because this is showing the order in which the Barbadian government acts to intervene after a surplus of the currency. First, the currency has to increase supply on the Forex market, which drops its exchange rate, and then they have to increase the exchange rate by demanding it, and therefore buying back this currency from the Forex market and getting rid of the increase, which overall should shift from the original equilibrium of here to the new equilibrium of here. So although now there's a greater quantity of Barbadian dollars in not just the Forex market, but in Barbadia too, the fixed exchange rate has been able to stay the same, hence the intention of the government intervening within the market. So basically, this is just showing how a market equilibrium works, just continuing the same theory from microeconomics. If supply shifts, then to get to the same price, we have to shift demand too. And it's important to note that the government can buy up this currency by using previously amassed reserves of foreign currencies. So this is actually quite interesting because the government clearly can't buy back Barbadian dollars by using Barbadian dollars. That completely defeats the purpose and just increases more Barbadian dollars overall. Hence, every country in the world keeps something called a reserve of foreign currencies. So for example, in this case, Barbadia might have a reserve or a certain amount of money saved in euros and dollars and in every currency in the world, just so that they have a bigger way of currencies to choose from that isn't their own. And so hence, by using the dollars and the euros and the pounds that they've saved from trade with all these other countries and continents, they can use that same currency to buy back the increase of Barbadian dollars and instead put more euros, pound, and dollars back into the Forex market, which obviously affects them in different ways that we'll investigate later on. But overall, Barbadia doesn't care because now they have rectified the problem caused by the surplus of dollars, okay? All right, now let's look at the flip version of the situation when demand increases for the currency first, continuing with the same example of Barbadian dollars. And as you guys can see, the one major difference here is that these numbers have been switched and showing that demand increases first before supply increases. So let's take a look at how this works. In the graph here, it shows the situation where the demand for Barbadian dollars is increasing on the foreign exchange market. Now, like we said before, the supply of Barbadian dollars on this Forex market, if I draw it again here, may be caused by imports. Because if they buy foreign imports and send their money out into the rest of the world, they send more money into here. Now, again, this may be caused by a bunch of different reasons. There's a bunch of reasons why people might increase their demand of Barbadian dollars. And we're going to be looking at more of these reasons later on. But for this specific example, let's say that people from the US and from Spain, okay, for example, want to visit Barbados for their holidays, and hence they need Barbadian dollars because you can't pay in Barbados with American dollars or with euros or with pounds or Canadian dollars. You have to use the given currency of the country, obviously. Hence, the demand curve for this currency is going to shift from D1 to D2. That outward shift again, okay? And this is step one. However, we run into another problem. Whereas before, the excess supply created a surplus, here, because between the new quantities Q1 and Q2 is where demand is greater than supply, causes an excess demand or a shortage, if I abbreviate, causes a shortage of the currency on the Forex market, meaning that there's not enough Barbadian dollars to go around to the other countries. And like we said before, whereas the original equilibrium would go down because of a surplus, now you have the opposite problem, whereby the exchange rate will increase from this original equilibrium here to the new equilibrium here. And instead, the quantity of the currency will increase, but so will the exchange rate, okay? So let's say this hits at 60 cents, meaning that the price of Barbadian dollars and US dollars is now 60 cents. Overall, we can consider this to be the exchange rate rising. As whereas before, one Barbadian dollar was 50 cents, well now, one Barbadian dollar is worth 60 cents, remember in American dollars, of course, meaning that now to buy the same good, you need less Barbadian dollars, meaning now that the exchange rate for Barbadian dollars is worth much more. However, the government doesn't necessarily want this. This isn't always a good thing, and we'll explore why later on. So to maintain its fixed exchange rate, because they want to stay at the 50 cents so badly, the Barbadian government will intervene, and they will do so by selling its own currency on the Forex market in order to satisfy the shortage or the excess demand. Thus, that's how they shift the supply from S1 to S2. They increase the supply. So essentially, in this intangible Forex market. So this is basically an example of how the Barbadian government is looking at the Forex market and being like, there's not enough of our currency to go around. Well, obviously, we can sell more of our currency so that other countries have it. And by selling their currency, two things happen. One, the other countries get more of the Barbadian currency, which meets the aim of more foreigners wishing to visit Barbados. And then also, because the other countries are paying in their own currency for the Barbadian dollars, then Barbados and the Barbadian government is going to be earning more foreign reserves. As we explained before, the reserves of foreign currencies can be gained in a bunch of different ways, but it's an aim for the government to earn a bunch of money in different currencies all around the world. And this is one of the ways that they can do it. If their currency is super in demand, and then other countries are willing to pay for their currency in terms of the other country's currency, then obviously Barbados will sell the Barbadian currency and instead will earn profits in US dollars, Canadian dollars, euros, pounds, and other currencies like that, okay? So overall, as we can see here, if I get rid of this so it's easier to see, we can see how because of the original increase in demand and then the subsequent increase in supply, overall, the quantity of Barbadian dollars has increased from quantity Q1 to Q2 and has been able to remain, as per the government's aim, at a fixed exchange rate of being one Barbadian dollar equal to 50 cents in US dollars. Okay, and lastly, while we've already considered before how governments and current banks can maintain a fixed exchange rate by either increasing supply or increasing demand in response to increased demand or increased supply, they can also do so by legal restraints. So let's talk about that. And the main way that legal restraints can do this is by making it illegal to trade currency at any other rate than the main exchange rate. However, obviously this is quite hard to enforce unless the government of the country has an effective monopoly over the conversion of the currency. So obviously the main government or central bank that wants to make a legal restraint against changing the fixed exchange rate will need intense power to do so, as they will need, as is described by the textbook, even a monopoly over the conversion of the currency to make sure that everything happens at this one exchange rate. And something interesting that the textbook brings up is how this was once attempted to be carried out with some mediocre success by the Chinese government in the 1990s to keep the yuan, which is their currency, pegged to the US dollar. However, the danger of this sort of control, of a government being able to control an entire fixed currency, is that a black market may typically emerge in the currency operating at a different exchange rate. Basically, basically this means that in a new black Forex market, which may emerge as a result, people will start trading currencies at cheaper prices because they want to spend less money, which overall negates the entire point of the government keeping a fixed exchange rate, as instead the exchange rate will begin either to fall or increase. Hence, it doesn't always work to use legal restraints, and it's very hard to do so. But now let's talk about the next type of exchange rate system. Let's discuss floating exchange rates, which is probably the most common in the world, which by definition is an exchange rate regime where the value of a currency is allowed to be determined solely by the demand for and the supply of the currency on the Forex market. Therefore, there is no government intervention to influence the value of the currency. Hence, the people of a given country or economy get to determine the exchange rate of this given currency. So let's take a closer look at this. All right, of course, given a beautiful new graph, which I'm sure nobody's excited to see, the market for a currency is shown in this following graph here. As you can see, we still have the price on the y-axis of one currency that we're investigating in terms of another currency that we're investigating, and the quantity of this first currency we're investigating. And to begin, we have a basic market equilibrium here with the supply of our given currency from the country that the currency is from. And then we're going to be contrasting that with the demand for US dollars from the EU, which is the euros, and the second currency we're going to be investigating. So in the particular case of this graph, this is going to be showing the market for US dollars in terms of euros, obviously. And as we can see, the demand curve is downward sloping and represents the demand for dollars by people in the EU, or at least people who hold euros, which might be a little bit outside the EU, but we're going to consider that all in the EU for now, or at least by people who hold euros. So although we like to believe that euros are designated to people who live in the EU countries that use euros, that's not always the case. And obviously there's going to be somebody somewhere in China, somebody somewhere in Thailand, somebody somewhere in America who has euros from spending it in those countries, but is now currently not placed in the EU and is somewhere else around the world. So this is actually going to be the demand for US dollars from the EU and people around the world who hold euros, okay? So the supply curve here is also normal, meaning it has a gradient of 1-to-1, meaning that it's not either incredibly elastic or incredibly inelastic, and represents the supply of dollars, which comes from those who hold US dollars. So again, the supply of US dollars comes from both the US and people who hold US dollars outside the US. Now, to begin with the equilibrium price, the exchange rate here is shown with equilibrium quantity at Q and equilibrium price at where 1 US dollar equals 80, it says it right here, but I'm just going to write it again, 80 euros in the EU. But now we're going to introduce two new terms that I'm sure you've heard of before because they're way more common than the terms used for fixed exchange rates and talking about devaluing and revaluing a currency, okay? So if the value of the currency in a floating exchange rate regime rises, we say that this is an appreciation of the value of the currency as it is rising, okay? Appreciation means to rise. If the value falls, then we say that there has been a depreciation, which means to decrease of the value of the currency. These terms must be used with floating exchange rates and must not be confused with the terms, like I mentioned before, revaluation and devaluation, which relate to changes in currency values in a fixed exchange rate system. So again, when it comes to answering questions on paper 2 or paper 3 if you're high level, or writing in an essay in paper 1, remember appreciation, depreciation, they rhyme, they're for floating exchange rates. Revaluation, devaluation also rhyme, but they're for fixed exchange rates. And it's so important that you don't get the terms confused for writing an essay or answering a question. But now let's continue with some examples of depreciation versus appreciation, okay? So consider a change in the value of the US dollar from the example before, from a first exchange rate of 1 US dollar to 0.80 euros to a second exchange rate of now 1 US dollar equaling 0.85 euros. So by underlining the two, we can begin to compare and contrast them. Overall, this shows the dollar has appreciated against the euro, okay? Because now, since 1 US dollar is worth more in the other currency, it's worth 85 cents versus 80 cents, the value of the dollar has increased. Oh, that's a really bad arrow. The value of the dollar has since increased and appreciated, by using the right terminology, against the euro. So we would say against the euro in this case, but you would say against in whatever given currency is used. In the first instance, 1 US dollar could buy 0.80 euros. And in the second, it has increased or appreciated in value to be able to buy 0.85 euros. Okay, and now this is where we're going to start expanding our knowledge about calculations of fixed exchange rates, which we will need to know. But let's start with an example. If a bottle of French wine costs 10 euros, then under the first exchange rate, this would be equal to $12 US dollars and 50 cents. Okay, when $1 equals 0.80 euros. But under this new second exchange rate, the price of the bottle of wine actually falls to $11.77 when 1 US dollar equals 0.85 euros. Okay, and obviously if you compare the two, because the value of the dollar has appreciated, the price of US buying European goods from the EU has decreased. So remember to not get the two confused. It's really easy to. But if the US can now buy the exact same thing for a cheaper price, that means the value of their currency has obviously appreciated, as now they don't have to use as much of their currency to buy the same thing. This also shows that the purchasing power of the dollar has risen, okay? And here's a quick little trivia thing for you. PPP. If you guys have seen that, all values of currencies are measured in PPP, which the last two P's stand for purchasing power. But continuing with the example, this means that a given amount of US dollars will buy more European goods. If we have 50 US dollars given the first and the second exchange rate, we can buy more with the second exchange rate than we can with the first. But let's flip it now. And let's consider if the euro value of dollars given the same exchange rate. If 1 US dollar equals 0.80 euros, then if we go ahead and flip the exchange rate to find the value of 1 euro, which would now equal 1 US dollar and 25 cents. So when the exchange rate changes, this is the value or how much 1 euro is worth in terms of US dollars according to this first exchange rate. And following the same method, using the second exchange rate, 1 euro begins to be equal to 1 US dollar and 18 cents, okay? And if we compare and contrast these two new values of how much 1 euro is worth before and after, this shows that the euro has actually depreciated, okay? As in the first instance, it is worth more US dollars than it is in the second exchange rate. This means that a given amount of euros will buy fewer American goods. So really quickly, I want to point out a common pattern between these two. Given an exchange rate of currency X compared to currency Y, if something happens in a floating exchange rate and one value increases or appreciates in value, the other must depreciate in value, and vice versa. If this first currency depreciates, then the second must appreciate, okay? There's no such thing, if we compare the two values, as double appreciation, because they would just be equal to each other, okay? So double appreciation and double depreciation do not exist. So if one depreciates or appreciates, the other must contrast and either appreciate or depreciate instead. So again, just to support what I said, notice how the appreciation of the US dollar against the euro occurs at the same time as the depreciation of the euro against the US dollar. Essentially, these are two sides of the same coin. And given by the textbook, this relationship can be further illustrated in the two diagrams below, whereby it shows the value of the Canadian dollar in euros and the value of the euro in Canadian dollars for a set period of time. So as you guys can see here, where the red line on the graph is highest means it's worth more, and where it's lowest means it's worth less. And as you guys can see, for example, starting with the one on the right, if the value increases, we can say it's appreciating, and as it decreases, it's depreciating. And as you guys can see here, if you compare the two, exactly when the euro appreciates and peaks is when the Canadian dollar depreciates or troughs. And obviously this can be seen in the resulting patterns. So essentially when it says here, they're two sides of the same coin, it means if you want to find the depreciation or appreciation value of one currency compared to another, you take the other currency and just flip it, because these are the same graphs, just upside down. But now, like I warned you guys, we are going to be tackling some practice questions. So in standard level and higher level paper 2 and in higher level paper 3, you may be asked to make various simple calculations relating to exchange rates and changes in exchange rates. So now we're going to be looking at some examples of the kinds of questions that you may face and some suggested responses from it. So starting with number 1. The US dollar is currently trading against the euro at a rate of 1 US dollar equals 0.80 euros. So what is the rate of 1 euro in US dollars? Okay, so now this is just some simple math we're doing here, okay? if this is the ratio before and we're trying to get this side equaling to 1, then think about it mathematically. How do we do that? Well, if you guys take any basic level of math, you know that x divided by x equals 1. Any value divided by itself equals 1. Therefore, if we divide 0.80 euros by 0.80 euros, that will make it equal to 1. But obviously we have to do the same for the other side, meaning that we now have to divide 1 American dollar by the 0.80 of the American dollar, which takes us to which basically flips the ratio to 1 euro being equal to $1 divided by 80 cents, which if we take out our calculator to calculate, would have this 1 euro equaling $1.25 in American dollars, which, as we saw in the example before, coordinates with the values they gave us. So now for number 2, with the given exchange rate that we found above, which if I rewrite it quite quickly, it's 1 euro is equal to 1.25 US dollars. What would be the cost in euros of a good that was selling in the US for $75? What we're going to do is first, because the good is being sold in the US dollars, we want to go back from converting the 1 euro to 1.25 US dollars to finding $1 in terms of euros, which given in the question before was 80 cents or 80 pence, I don't know, 80 cent euros equals 1 US dollar. So now what we do is, now we can multiply each side by 75 in order to find the price in both US and European currency. So if we multiply both sides by 75, we would get 0.8 times 75, which is 60 euros. It's equivalent to buying the same thing for $75 in US dollars. All right, and last question, we're going to look at how, if the exchange rate changes, like we saw in an example before, from 1 US dollar equals 0.80 euros to 1 US dollar equals 0.90 euros, explain what would happen to the price of the euro at a US manufactured dress shirt that was being exported to Europe from the USA at a cost of $150. All right, so now we're going to take the method that we used in the last question in question 2 and apply it to 2 different exchange rates, okay? So as we saw before, if we take this and we multiply it by 150, so 0.8 times 150, using this first exchange rate, it would equal 120 euros in Europe when you import a US manufactured shirt to buy said shirt. So that would be in euros, okay? Now with the converted exchange rate, we're going to do the same thing, 150, but times 0.9, okay, because that's now the new changed exchange rate. And if we use our calculator again, 0.9 times 150 is going to equal 135 euros to buy the same shirt, but at a different exchange rate. And obviously between these 2 exchange rates, we can see how there has overall been an increase in 15 euros between the 2 exchange rates, as now it costs Europeans 15 more euros to buy the same shirt. And using the terminology that we've already studied before, we can see how, because now the US dollar is worth more euros after than it was before, the US dollar has increased or appreciated in value. So the US dollar has appreciated in value, whereby the euro, obviously if the dollar appreciates, then the euro has to have depreciated in value overall. All right, but like I already predicted before, I said that I would explain to you guys some examples of what increases the demand and the supply for currencies. So let's start by talking about demand. Now we need to consider what factors will shift the demand and the supply curves for a currency. First, let us look at the demand curve using the same example that we just explored of the demand for US dollars by people in the EU. So therefore, people in the EU will have to buy US dollars or demand US dollars in the Forex market if they want to achieve any of the following aims: buy US exports of goods and services and travel to America, invest in US firms, save their money in US banks or other financial institutions, or make money by speculating on the US dollar. So any of the above reasons here could be reasons why the EU needs American currency. But now let's look in a little bit more detail at these following points, okay? The demand for the US dollar, if the EU wants to achieve any of the following aims, will occur if there is an increase in the demand for US goods and services. This could be caused by 3 separate things. US inflation rates being lower than EU inflation rates, making US goods and services relatively less expensive than EU goods and services. Hence, domestic consumers of the EU will want to import foreign products from the US. An increase in incomes in the people of the EU, so people in the EU increase their demand for all things, including imports from the US. And lastly, a change in taste in the EU in favor of US products. These 3 points here are basically just showing why the EU might potentially want to increase imports of US goods and services, but obviously it's not just limited to these 3, and instead there are a multitude of reasons beyond this, of reasons why the EU wants to import goods. But for the second point, U.S. investment prospects improve due to, for example, strong economic growth in the U.S. or the implementation of new business-friendly policies. Hence, more people from other countries, including people from the EU, will want to invest in U.S. businesses as they believe they can expand economic growth, they can make more revenue overall, and they can just invest in their branches of the businesses from the EU into the U.S. territory. U.S. interest rates increase, making it more attractive to save there than the EU financial institutions. So for example, if I had 2 options, I could invest $100 into an EU bank, which paid me $10 interest rate, or I could invest my money into US bank, which pays me $15 of an interest rate. Obviously, I want to send my money abroad to the US as I get paid more money over a longer amount of time. Hence, they have an incentive to invest their money into US banks. And lastly, if spectators in the EU think that the value of the US dollar will rise in the future, they might go ahead and buy it now. So kind of the idea of predicting the value of currencies before and after. And if they are correct, then they will be able to sell those US dollars in the future when they are worth more and make a financial gain. Just kind of like how people buy stocks in the first place. If people think the value of stocks is going to rise, they're going to buy them now, and then when they need the money, they're going to sell them for more later and make a gain. It's the same thing with buying currencies. All right, but just to summarize, we can remember these 4 points here of reasons why currency demand increases using the very bad acronym I came up with. PI. I couldn't find a good acronym for this, I swear, because what these stand for, predictions, interest rates, investments, and imports, there's no other way to organize this in a good way. So just say pi is the number of reasons why currency demand increases. And now we can look at this graph right here, which again is a microeconomic graph as shown by the singular D. Which shows the increase in demand for the US dollar. So obviously this is quite straightforward. Price of the dollar in the other currency and then quantity of the dollar, okay? Supply curve of the dollar from the country that makes it and the demand for the dollar from the second country we're investigating. And as we can see here, an increase in the demand for the US dollar from the EU will shift the demand curve for the US dollar to the right to D1. Okay, this would be D and this would be D1. And when this happens, the value of the dollar will appreciate and it will now be worth 0.9 euros. Okay, remember from before it goes from 0.8 euros to now 0.9 euros. Each US dollar may be exchanged now for a larger amount of money or a larger amount of euros. Hence, this is showing exactly how the value of the US currency appreciates in value. So if you're ever given a graph like this and you need to quickly distinguish whether the currency of US dollars appreciated or depreciated in value in an exchange rate, you can just simply look at the equilibriums. If the original equilibrium is below the new equilibrium, then the value appreciated. If the original equilibrium is higher than the new equilibrium, then the currency decreased or depreciated in value. But now let's look at the opposite. Let's see what increases the supply for a currency, okay? Well, considering the same example from before, the US dollar will be supplied on the Forex market when Americans want to meet any of the following aims: buy EU goods and services and travel to Europe, invest in EU firms, save their money in EU banks or other financial institutions, or to make money by spectating on the euro. In all the cases above, Americans will need euros and will have to exchange dollars to get those euros. This will overall increase the supply of dollars on the Forex market. And clearly, if you guys remember from the PI acronym I used before, these 4 reasons that Americans want euros are the exact same reasons why Europe would want American dollars. Okay, so again, if you wanted to remember both the reasons for supply and demand of a currency, you would use the same acronym, PI, because obviously from both sides, it helps them supply and demand currency. But again, bringing back this graph and a deeper analysis of each point. Thus, the supply of the US dollar will rise if any of the following occur. Americans increase their demand for EU goods and services, thus exchanging more US dollars for euros. And obviously, when you consider the US supplying more US dollars in exchange for euros, then going back to this little corner I drew of the intangible Forex market, more US dollars will appear outside the US, meaning that the amount of dollars will increase. And this could be caused by three different reasons. Number one, US inflation rates being higher than the EU inflation rates, and thus US goods and services becoming relatively more expensive than EU goods and services. An increase in incomes in the US, so people in the US increase their demand of all things, which includes imports from the EU. A change in taste in the USA in favor of EU products. So again, this whole section right here is just repeating the exact same reasons that we used for Europe wanting more American dollars, but this time we just switched the countries. Number two, EU investment prospects improve. Number three, EU interest rates increase, making it more attractive to save there than in US institutions. And lastly, spectators in the US think that the value of the US dollar will fall in the future, so they now sell it and buy euros. If they are correct, they will be able to buy US dollars back again when they are less expensive and so will make a financial gain. Again, this is referring to the same strategy that people use in the stock market, where if the US is predicting that the value of their currency will depreciate over coming years, they will sell it now for a lot of money and then buy it back later when it's cheaper and overall make the same financial gain. An increase in the supply of US dollars is also shown here. So given the exact same context as before, the only difference is that the supply has shifted instead of the demand from an original curve of S to S1. And as we can see here, based on where the original versus the new equilibrium is and looking at prices, we can see what has happened to the value of the US dollar. As you can see here, it has gone from being worth 0.80 euros to being worth 0.70 euros, meaning that the US dollar has depreciated and decreased in value. Therefore, each US dollar may be exchanged for a smaller amount of euros now. All right, and lastly, we already considered both fixed and floating exchange rate systems. But now let's talk about the last category, a managed exchange rate system. So while the floating exchange rate system of the currency being determined by everyday changing demand and supply of consumers, in reality, there is no currency in the world that is allowed to be completely freely floating. As even where governments try to be as non-interventionist as possible, there will come times when the currency is subject to extreme fluctuations and the government or central bank will feel as though they must intervene. So this is just introducing the idea that although the floating exchange rate is optimum, it's also unrealistic and completely theoretical because there's never going to be a country in which the government or central bank does not want to intervene and manipulate the exchange rate at certain times. In the same way, frequent changes in the exchange rate, if it was completely free floating, would cause uncertainty for businesses, which is definitely not good for trade. And so governments will be forced or feel as though they're forced to intervene in order to stabilize the exchange rate. So let's take a look at how this is done. Because of what we just said, most exchange rate regimes in the world are managed exchange rates, which is just adapting the same theory of floating exchange rates, but intervening slightly. These are exchange rate regimes where the currency is, like I said, allowed to float, but with some element of interference from the government. And in terms of managed systems, the most common types are where the central bank, not the government, but the central bank, will set an upper and a lower exchange rate value and then allow the currency to float freely, so long as it does not move outside of that band. If the exchange rate starts to get close to the upper or lower level, then the central bank will intervene in the foreign exchange market for its currency. However, central banks do not make these upper and lower levels or bounds for the currency public for fear of speculation, but they do certainly exist. And we don't know to what extent they exist, but they certainly do in most economies. All right, so now that we got the three exchange rate systems out of the way, let's talk about the advantages and disadvantages of exchange rates increasing and decreasing. So the actual level of the exchange rate will have marked economic effects upon a country, and we need to look at these now to fully understand why governments intervene to influence the value of an exchange rate. And subsequently, we will look at how governments intervene. So let us look in turn at the possible advantages and disadvantages of high and low exchange rates. And as a quick overview of both the limitations and benefits of high and low exchange rates, it is summarized into this small paragraph here. A high value of a currency may be good to fight inflation, but may create unemployment problems, whereas a low value of a currency may be good for solving unemployment, but may create inflationary pressure. But now let's look at this whole thing in more detail. So starting with the advantages of high exchange rates, let's take a look. Number one, downward pressure on inflation. If the value of the exchange rate is high, then the price of finished imported goods will be relatively low. In addition, the price of imported raw materials and components will reduce the cost of production for firms, which could lead to lower prices for consumers overall. The lower price of imported goods also puts pressure on domestic producers to be competitive by keeping prices low. So essentially, this is just saying that by buying either materials or finished imported products above, if you have a high exchange rate with the currency of that given country that you're importing from, then it will appear relatively cheaper than it would have if the exchange rate would be low. Hence, everything seems cheaper in this given economy. Not to mention that the lower price of imported goods puts the pressure on domestic producers to be internationally competitive compared to other countries. And a main way they do this is by keeping their prices low on the world market. Number 2, more imports can be bought. Well, so if the exchange rate is high, then each unit of the currency will buy more foreign currencies, and so more foreign goods and services. This would include both visible imports, such as technology, and invisible imports, such as foreign travel. So essentially, it's just continuing the idea with the basic theory of demand. If something is cheaper, then we can buy more of it given a set amount of money. And number 3, a high value of a currency forces domestic producers to improve their efficiency. Kind of continue the same idea here. The high exchange rate will threaten their international competitiveness, and so they will be forced to lower costs and become more efficient in order to maintain competitiveness. And while this might result in the laying off of workers, there are also other means of increasing efficiency that will result in greater economic productivity for the country. But now for the disadvantages of high exchange rates. Number 1, damage to export industries. So if the value of the exchange rate is high, then export industries may find it difficult to sell their goods and services abroad because of the relatively high prices. This could lead to unemployment in these industries. So that's a big concern right here, which is unemployment. So this is basically getting at the idea that if the domestic industry has a high exchange rate, because it's so high compared to the rest of the currencies in the world, it makes things that they import seem cheaper, but at the same time, it makes things that they export seem more expensive. Thus, the export industries and the economy begin to suffer, which might cause unemployment if they cannot sell as many exports as they need to. And number 2 is damage to domestic industries overall caused by this. So with greater levels of imports being purchased overall because imports are now relatively less expensive, domestic producers may find that the increased competition causes a fall in the demand for their goods and services. This may lead to a further increase in the level of unemployment as firms cut back, basically saying that high exchange rates of a domestic country make everything look cheap to them when coming from abroad. Hence, they will purchase more things from abroad and less things from the more relatively expensive domestic producers, which again increases unemployment if they have to cut back a lot. But now in contrast, let's take a look at advantages of low exchange rates this time. Number 1, greater employment in export industries. If the value of the exchange rate is low, then exports from the country will be relatively less expensive and so more competitive. This in turn may lead to more employment in the export industries. So this is the idea that if other countries see the domestic country as being incredibly cheap to buy from and cheaper than their own domestic countries, then obviously the export industry of the domestic country will thrive as they send it all over the world to everybody who wants to buy their cheaper product, okay? Which can also increase more employment as more business is made. And number 2, greater employment in domestic industries as well. So the low exchange rate will make imports more expensive than they were before, which may be a good protectionist measure in encouraging domestic consumers to buy domestically produced goods instead of things like imports, which may also raise employment of domestic industries. And lastly, let's take a look at disadvantages of low exchange rates. And the main one we're going to be looking at is, again, inflation. So a low value of the currency will make imported final goods and services, imported raw materials, and imported components more expensive. And a lot of times, these imported components are necessary things that the economy needs in order to survive. The raw materials and components are needed, and so therefore, the cost to firms for production will rise, possibly leading to higher prices in the economy. The final goods and services will have higher prices. Thus, there's a serious likelihood of inflation, as think about it in the chain and sequence of events. If firms have to pay more for primary commodities, and therefore it costs more money to produce, then therefore they can only make revenue if they sell the product for a higher amount of money. And if this happens to every industry in an economy, then obviously this is a huge case of inflation arising. Okay, and the last part of standard level content we're going to cover is the government's perspective of exchange rates. So we're going to look at why and how do governments intervene in the Forex market. To begin with why. There are a number of reasons why governments may intervene in the Forex market to influence the value of their currency. And considering the advantages and disadvantages of both high and low exchange rates from before, the governments can do this in case they wish to impact any of the following. They can start by lowering the exchange rate in order to increase employment, raise the exchange rate in order to fight inflation, maintain a fixed exchange rate to stay the same, avoid large fluctuations in a floating exchange rate, achieve relative exchange rate stability in order to improve business confidence, and improve a current account deficit, which is seen where spending on imported goods and services is greater than the revenue received from exported goods and services, which we're going to get into the next chapter, balance of payments, later on. But now let's look at some reasons how governments intervene in Forex market to meet any of the objectives listed before. So whatever the reason is for the intervention, we should now consider how governments attempt to manipulate the exchange rate. And there are two main methods that we're going to break down into sections, including using foreign reserves of currencies and by changing interest rates. So let's take a look. All right, number one, using reserves of foreign currencies. And before we even get started on reading here, I want to point out I mentioned earlier, reserves of foreign currencies is essentially where countries have a reserve, which is like an intangible set amount of money in international currencies that aren't their own, in case they want to either to buy or sell these foreign currencies for many reasons. For example, if the government wishes to increase the value of the currency, then it can use its reserves of foreign currencies to buy its own currency on the foreign exchange market if they want to increase the value of domestic currency, that is. This will increase the demand for the currency and so force up the exchange rate, like we saw earlier in the video. And in the same way, if the government wishes to lower the value of its currency, then it simply buys foreign currencies on the foreign exchange market, increasing its foreign currency reserves. To buy the foreign currencies, the government would use its own currency, and this increases the supply of the currency on the Forex market, and so lowers the exchange rate. So this is essentially just connecting back to how at the beginning of the video, we saw that if there's either an intense supply increase or demand increase in a domestic currency, the government can intervene to either contradictingly increase supply or demand in order to keep the same equilibrium price for any of the following reasons that we read here. And just by a little definition, if you don't know specifically what the word reserves mean, it means either a liquid or intangible asset of foreign currencies in the Forex market, collected through foreign imports or from exchanging domestic currencies through the central bank. So essentially just continuing the same definition I gave before for reserves of foreign currencies. And lastly, we're going to look at how governments intervene by changing interest rates. So if the government wishes to increase the value of their currency, then they may raise the level of interest rates in the country. This will make the domestic interest rates relatively higher than those abroad and should attract financial investment from abroad because of that. In order to put more money into the country, the investors will have to buy the country's currency, thus increasing the demand for the domestic currency, and so its exchange rate will increase. In the same way, if the government wishes to lower the value of their currency, then they may lower the level of interest rates in the country. This will make the domestic interest rates relatively lower than those abroad and should make financial investments abroad more attractive. In order to invest abroad, the investors will have to buy foreign currencies, thus exchanging their own currency and increasing the supply of it on the financial exchange market. This should lower its exchange rate tenfold. And again, another quick definition in case you don't know the exact definition of an exchange rate used for this slide here. It is the percent of an amount of money paid for its use over time, typically given from banks. Higher interest rates are more attractive as over time the person's account will earn more money back than they started with. So if you guys consider this and everything I said here, then you can see how if the country increases its exchange rate, it will be attractive to foreign investors. And in the opposite dent, if a country decreases its exchange rate, then foreign investments will be more attractive to domestic investors. And that'll be it for standard level content for exchange rates. However, if you're higher level, we still have a little bit more to do. But all right, so for fellow higher level students, we have to quickly do a little bit more theory practice before we end exchange rates. But don't worry, it's nothing new. It's just us beginning to evaluate fixed and floating exchange rates and talking about the advantages and disadvantages of each of them. So to begin, let's start by evaluating the advantages of fixed exchange rates. Now remember, by definition, a fixed exchange rate is when an exchange rate is fixed to a certain product or another currency or an average of different currencies, okay? That's what it means to be fixed or pegged in place. So now let's go along. Number one, a fixed exchange rate should reduce uncertainty for all economic agents in the country. Businesses will be able to plan ahead in the knowledge that the predicted cost and price for international trading agreements will not change. And this is because countries try so hard to keep their exchange rates in fixed exchange rate systems fixed in place. That's the whole point of it. So this is good for businesses because if businesses want to invest in that country with a fixed exchange rate system or branch out a certain industry into that country, well, they'll easily be able to plan ahead in the knowledge that their costs and prices for extending their business or investments is going to stay the same. Okay, so they don't have to worry about any fluctuations that you might find in a floating exchange rate economy. Number two, if exchange rates are fixed, then inflation may have a very harmful effect on the demand for exports and imports. And I'm sure you're wondering, well, then why is this an advantage? Well, this is because then the government is forced to take measures to ensure that inflation is as low as possible in order to keep businesses competitive on foreign markets. Thus, fixed exchange rates ensure sensible government policies on inflation. So essentially, this is showing that even though there's a very big disadvantage to fixed exchange rates and that inflation has a very harmful effect on the demand for export and import industries, because think about it, if an exchange rate is fixed and it doesn't change, but everything else in the economy becomes more expensive, that exchange rate change between currencies will give people more severe limitations in being able to buy imports and sell exports using their fixed exchange rate. However, the good thing about this is that because governments are aware that inflation is super detrimental for economies with fixed exchange rates, they always have to be aware of inflation and try to keep it as low as possible. So if we look at this in a positive way, this shows how because of fixed exchange rates, governments have to be aware of inflation at all times, and making inflation as low as possible in the economy quickly becomes a number one priority, which, as we know, benefits the entire economy overall for a long period of time. And lastly, number three, in theory, the existence of a fixed exchange rate should reduce speculation in the foreign exchange markets, or the Forex markets. In theory, the existence of a fixed exchange rate should reduce speculation in the Forex markets. Again, this is talking about how the whole idea of an exchange rate being fixed reduces speculation for things like businesses who want to invest in the country, as they will no longer speculate on if the value is going to increase or decrease for that fixed exchange rate, because the whole point is that it's fixed and it doesn't fluctuate. And while this is all theoretical, we do have to consider in reality, this has not always been the case, and there are often attempts to destabilize fixed exchange rate systems in order to make speculative gains. But now let's take a look at some disadvantages of these fixed exchange rates. Number one, the government or central bank, the two stakeholders who control the fixed exchange rate fluctuations, are compelled to keep the exchange rates fixed. Obviously, that's the whole point. They want to keep it fixed and pegged in place. The main way of doing this is through the manipulation of interest rates, as we saw before. However, this may have the potential or possible negative consequences for the domestic economy. For example, if the exchange rate is in danger of falling, then the central bank will have to raise the interest rate in order to increase demand for the currency. But this will have a deflationary effect on the economy, therefore lowering demand and increasing unemployment. However, as we already know from our knowledge of the macroeconomics unit, this might have a deflationary effect on the economy, thereby lowering demand as people choose to keep their money in the banks, gaining more interest instead of spending it. And if this happens to a detrimental extent, it can increase unemployment, as when less people are buying a set amount of goods, then less production needs to take place and less people need to be employed for the smaller production scales. This means that a domestic macroeconomic goal, such as low unemployment, may have to be sacrificed. Number two, in order to keep the exchange rate fixed and to instill confidence on the Forex markets, a country with a fixed exchange rate has to maintain high levels of foreign reserves in order to make it clear that it is able to defend its currency by the buying and selling of foreign currencies. So this is actually an interesting point right here. It's basically saying that although all countries always want to have a very good level or high level of foreign reserves in place in case they ever need to sell or buy their own currency using the foreign reserves, A country with a fixed exchange rate specifically always needs to make sure it has high levels of foreign reserves, as the main way for these economies to be able to defend, as quoted in the textbook, or be able to make sure that the fixed exchange rate of their currency stays the same, is through this buying and selling of foreign currencies. Therefore, fixed exchange rate systems and the economies of it need to always have a very high level of foreign reserves ready. Okay, number 3, setting the level of the fixed exchange rate is also really complicated. It is not simple, as there are many possible variables to take into account, and also these variables change over time. For example, if the rate is set at a level which is too high, then export firms may find that they are not competitive in foreign markets, as the country with the high fixed exchange rate level will appear way more expensive to other countries. And if this is the case, then the exchange rate will have to be devalued. But again, finding the exact right level is very difficult and takes lots of trial and error, and also a lot of time to do. And lastly, number 4, a country that fixes its exchange rate at an artificially low level, meaning that all products produced in the country appear as very attractive export industry to many other countries, as they now want to import from the country with the low level of a fixed exchange rate, since it's so much cheaper, may create or face international disagreement. This is because a low exchange rate will make that country's exports more competitive overall on the world markets and may be seen as an unfair trade advantage, which may in the future lead to such economic disparities or retaliation, such as where they might face things that we already looked at in the protectionism and free trade chapter, whereby we saw examples of certain products from certain countries getting tariffs put on them or getting completely embargoed because other countries don't consider the country with a super cheap exchange rate to be fair on the world market. And lastly, let's talk about the advantages and disadvantages of floating exchange rates, okay? If you guys remember from the beginning of this video, a floating exchange rate is not determined by the government or the central bank, but is instead determined by the consumer supply and demand of that specific currency, and that's what gives that currency value. Some advantages of a floating exchange rate system, though, may include, number 1, because the exchange rate does not have to be kept at a certain level, interest rates are free to be employed as domestic monetary tools and can be used for demand management policies, such as for controlling inflation. Thereby, interest rates do not need to control the floating exchange rate and its fluctuations, given that it's between the two indivisible bounds set by the central bank, and therefore the very impactful government intervention of interest rates and manipulating them can be used to fulfill demand management policies. Number 2, in theory, the floating exchange rate should adjust itself, should be self-perpetuating in order to keep the current account balanced. Okay, now this is a phrase we're going to become super familiar with in the next chapter of balance of payments, but don't worry if you don't know that for now. For example, if there was a current account deficit, which is just the country's account, let's just call that for now, then the demand for the currency is low, since export sales are relatively low, and the supply of the currency is high, since the demand for imports is relatively high. This should mean that the market will then adjust itself and that the exchange rate should fall because of it. Following this, export prices become relatively more attractive, import prices relatively less so, and so the current account balance should righten itself. Now, this is a very simple and summarizing definition of how the floating exchange rate affects the current account deficit and surplus. However, if you don't understand it too much thus far, don't worry. Like I said before, we'll explain it in much more detail in the next chapter. And lastly, number 3, because reserves are not used to control the value of the currency, it is not necessary to keep high levels of reserves of foreign currencies and gold or other commodities that typically fixed rates might base their fixed exchange rate off of, which means that typically countries with completely floating exchange rates are way more vulnerable to not keeping high levels of foreign reserves, and so when they need these reserves, they either don't have enough or don't have them at all, which can pose huge problems in the future in adjusting the supply or demand of their exchange rates. And the last slide, we're going to be looking at the disadvantages of floating exchange rates. So number 1, floating exchange rates tend to create uncertainty on international markets, as businesses try to plan for the future but find it difficult to make accurate predictions about what their likely costs and revenues will be because the floating exchange rate changes every single day, and in fact, every single second. Therefore, investment is more difficult to assess, and so there is no doubt that volatile exchange rates will reduce the levels of international investment because it is difficult to assess the exact level of return and risk for foreign businesses. Number 2, in reality, floating exchange rates are affected by more factors than simply demand and supply, although that's what we simplified it down into. Other things such as government intervention, world events, and business speculation affect the exchange rate. Because of this, they do not necessarily self-adjust in order to eliminate current account deficits, and instead may need support from some form of government intervention in order to be self-perpetuating, like that given economy needs it to be. And lastly, number 3, a floating exchange rate regime might worsen existing levels of inflation. For example, if a country has high inflation relative to other countries, then this will make its exports less competitive and its imports relatively less expensive, thereby saying that the country doesn't export a lot but imports a lot. The exchange rate will then fall in order to rectify the situation. However, this could lead to even higher import prices of finished goods, components, and raw materials, and thus costs push inflation, which may further fuel the overall inflation rate in the given economy. And that will be it for higher level and standard level content of chapter 4.4 in IB Globalization about exchange rates.